Welcome to part 5 of our chapter 8 discussion. So in the first two videos, we were looking at these different cost flow assumptions and the specific identification method, all from the perspective of a perpetual inventory system. But what about if we're using a periodic inventory system instead? Well, remember, one of the main ways that a periodic system differs from a perpetual system is that with the periodic system, we're not updating inventory and cost of goods sold throughout the year. Instead, we wait until the very end of the year to count inventory to figure out what the ending inventory is, and then we use that figure to actually compute our cost of goods sold for the year. Now that's different from a perpetual system where every time you make a sale, you also record the cost of the sale. So under a perpetual system, we're constantly updating cost of goods sold and inventory. But under a periodic system, however, we wait until the end of the year to determine both ending inventory and cost of goods sold. So here they give us beginning inventory, all these purchases, and then they went and counted and determined of the 30 units that they had available to sell for the year, they had 12 left at the end of the year. So they were able to determine, okay, that means we sold 18 of the 30. So the cost of goods available for sale here is $3,000 and 30 units available. So given this information and given how a periodic system works, we're going to look at all four methods here: specific identification, average cost, FIFO, and LIFO. And depending on the method, we're going to figure out what our cost of goods sold is. So under specific identification, this is not an assumption. This is not a cost flow assumption. It's actually the method where you have to exactly determine the cost of the units you sold. So here, the company is going to have to identify the 12 units that they have left over. So they're going to have to identify the 12 food processors on hand at year end and determine their actual costs by looking at the purchase invoices. So we're just going to assume they went in and checked and saw that, okay, those 12 units that we have left, according to these purchase invoices, those 12 units that we have left cost us $1,240. Now, since we know the cost of the ending inventory, we can actually calculate cost of goods sold. Because remember, one of those foundational computations that we learned about back in chapter 6 is this one we have here. Remember, you have beginning inventory plus purchases. That gives you cost of goods available for sale. But you take beginning inventory plus purchases minus your ending inventory, that gives you cost of goods sold. So if we know each of these, we can find cost of goods sold. So now under specific identification, they tell us that these 12 units that we have left, according to those purchase invoices, we know the exact cost of those units that we have left, the 12 left, is $1,240. That we know. So we're going to use this calculation here to determine, okay, given that, what is the cost of goods sold then under this method? Well, we start with our beginning inventory, which has a cost of $800, plus our purchases. So we have several purchases here. So we have 1, 2, 3, 4. So we have 4 purchases. So let's go ahead and add those purchases together so we don't have to necessarily list them all there together. So we have a purchase of $450 plus a purchase of $500 on July 1st, then another purchase of $600 on October 1st, and then another purchase on December 1st of $650. So there's total purchases of $2,200 made throughout the year. So 800 plus 2,200, that is cost of goods available for sale, which we have here of $3,000. And remember, from the cost of goods available for sale, we simply subtract the ending inventory. And the cost of the ending inventory we know is $1,240. Once we subtract that ending inventory, we can calculate our cost of goods sold for the year. And our cost of goods sold for the year is going to be $3,000 minus $1,240. That is $1,760 of cost of goods sold that we will get to record on the books. Now, we could have done this a slightly shorter way. See, we already knew what our cost of goods cost of goods of, let me just write that correctly here. We know what our cost of goods available for sale is because of that table. They totaled that ahead of time. So we could have simply taken the cost of goods available for sale and subtracted out the ending inventory cost to get to the $1760. But it's good practice to write it out in this way. So remember, once you know your new ending inventory and you know your cost of goods sold, that's when we would do that series of 2 entries that we learned about last chapter to actually update those books correctly under this periodic system. All right, now what about under the average cost method? How are we going to find out what the cost of goods sold is? Well, we start with the units that we have left over. We want to first cost those, and then we can do the same calculation. So the only difference is, depending on the method, the cost of your ending inventory will be slightly different, but how you calculate cost of goods sold will be the same. So remember, first step under this method is to find your average cost per unit. So the total cost that we have available here was $3,000. Divide that by the units available of 30 units. So the total average cost per unit here, that comes out to $100. So we would take the 3,000 divided by 30 as $100. So that's our average cost. So we want to first find the ending inventory cost like we did up above, which they told us under the specific identification method. So if there's 12 units left and the average cost of each unit is 100, we'll take the average cost of 100 times the 12 units you have left to determine that, okay, the ending inventory cost is $1,200. Well, I know that if I subtract ending inventory from the cost of goods available for sale, I get my cost of goods sold. So we can simply take that $3,000 of cost of goods available for sale minus my ending inventory cost of $1,200 to determine that my cost of goods sold here is $1,800. So remember, once you find your ending inventory cost and you know your cost of goods available for sale, you can simply subtract the ending inventory cost from cost of goods available for sale to find your cost of goods sold. So that's that for average cost. Now what about FIFO, first in, first out? Okay, so again, very similar. The only difference is how we determine the cost of ending inventory. That's what we always want to find first, is cost of ending inventory, because we know this is our cost of goods available for sale, but we know that cost of goods available for sale minus ending inventory cost gives us cost of goods sold. So how many units do we have left? Well, we have 12 units left. So that means we sold 18. So under FIFO, remember it's first in, first out. So that means when we sell something, we're assuming we're pulling from the older items first. So under FIFO, if you're selling the older items first, that means you're left with the newer items. So newer items are left over in ending inventory. Okay, so the newer items would be December 1st and up. So the newest cost layer here is from December 1st. So we would start by December 1st and work our way up to determine what the ending inventory would be made up of under FIFO. Okay, so if it's first in, first out, remember we were assuming we were pulling from the top layers first when we were selling things, leaving us with the bottom layers mostly. So that means if ending inventory is made up of the newer stuff, that means we have and there's 12 units left, that means we have all 5 units from December 1st left. That cost us $130 each. So 5 times $130, that gives us $650. And that means we also have that entire cost layer from October 1st left as well. And those 5 units cost me $120 each for a total of $600. And then because we have 12 units left, we also have a little bit left of the July 1st purchase. So 5, 5, and then 2 to give us 12. So that means we also have 2 units left of the July 1st purchase, and each of those units cost us $100 each. So those 2 units that we have left from that cost layer cost us $200. So if we add 650, 600, and 200 together, that gives us 1,450. So our ending inventory cost under FIFO is 1,450. So we're not done because we're trying to find cost of goods sold at the end of the day. So we know our cost of goods available for sale is 3,000. Remember, we go with cost of goods available for sale minus your ending inventory cost of 1,450 equals our cost of goods sold, based on that basic foundational calculation from Chapter 6. So we'll take 3,000 minus 1,450, and that gives us $1,550 of cost of goods sold under the FIFO method here. Okay, so the calculation is the same. It's just how you end up finding ending inventory cost is different depending on which method we're using here within the periodic system. And then lastly, last in, first out. So remember, with this method, you assume you sell the newer items first, so that leaves us with the older items mostly left in inventory as ending inventory. So last in, first out, you sell the newest stuff first. So when you sell something, you pull, we're assuming we're pulling from the bottom layers first, leaving us with mostly the top layers. So again, we know we have 12 units left. So let's figure out what that would be broken down into under LIFO. So the 12 units we have left under LIFO, they would be made up of the older items first. So we would have to start from the top layer and work our way down. So that means we have the entire beginning inventory batch still intact that we have left over. So 10 units, and each of those units cost us $80 each for a total of $800. And since there's 12 units left, that means we have that entire first layer left over, but then also 2 units left from the July 1st cost layer, and each of those cost us $100 each. Sorry, not $100, $90 each, that second cost layer. That's a total of $180. So under the LIFO method, 800 plus 180, that's $980 of ending inventory cost. So remember, we take our cost of goods available for sale of $3,000 minus our ending inventory cost, in this case of $980. That's going to give us our cost of goods sold. So we're going to take that $3,000 minus the $980. That gives us $2,020 of cost of goods sold for the year under the periodic system. So LIFO, FIFO, average cost, specific identification, all of them are applicable regardless of if it's a periodic or perpetual inventory system in use. However, if you're using a periodic system, we just have to remember there's extra math involved to find ending inventory and cost of goods sold at the end of the period. And then you have to still factor in which method you're using, because the method used will affect the cost of goods sold calculation at the end of the day. So that's for part 5 of chapter 8. Continue watching for part 6.